Uh, so this is our second class. I hope you can remember the diagram which I drew on the board, indicating the credit process, starting from the origination, that is finding a customer, and ending with collecting all our money back, right? And which was covered by an umbrella called credit policy. So today we will discuss further on the credit policy, and then we will go to discuss the type of borrowers. Right? So we'll start. So credit policy, which is the overriding umbrella. So we will discuss what is a credit policy, who should propose it and approve it, what are the underlying bases, areas to cover, exceptions, who owns it, and how the policy can be structured. These parts we will discuss at the first part of our lecture today. What is a credit policy? Credit policy is a formalized high-level lending guideline that bank need to follow in granting credit. This is a broader guideline which will indicate how to onboard a customer, how to evaluate, what kind of facilities we can give, what kind of exposures we can give, who should approve these things, how to monitor, how the documentation should happen, how the provisioning should happen, responsibilities of different departments, recoveries, provisioning, MIS requirement, everything will be covered under this high-level guidance, right? It will show us the broader risk appetite of the bank. Are we having a very good risk appetite, or are we very conservative? We spoke about 3 credit cultures: value-driven culture, then current profit-driven culture, and the market share-driven culture. So under value-driven culture, we had very tight criteria because our aim is to minimize the NPL. Our portfolio quality should be very good. So in that kind of a scenario, credit policy will be very strict. It will give very strict risk guidelines. So we can't give easy credit or clean credit or risky credit. We can't give. Right? Then we come to the profit-driven culture. Their credit policy would be little lighter, where we have the option of going out and bringing little riskier customers. Market share driven, also the same. The aim of market share driven culture is to get everyone. In that scenario, good and bad, it is a mix. Whereas the first scenario, it is a completely good customers, right? So all these processes are governed by the credit policy, right? It provides a strategic direction to lending function. Credit policy gives the strategic direction to lending function. Who should propose it and who should approve it? Yes, it is the management of a bank who proposed it, but it should be approved by the board of directors, because bank runs based on the direction given by the board of directors, not that management will set the direction. Board of directors will set the direction. So if something goes wrong, our authority, CVSL, or the credit supervision or the central bank, will catch hold of the board of directors first, then only the top management and subsequently, right? So on the credit policy, management can propose it, but board of directors has to approve it. So credit policy is the direction, broader direction given by the board of directors to guide the bank in credit function. Board is responsible for misdirection of credit and wrongful credit policies in the eyes of regulators. This is the agency theory. And that is, you have a board, and whatever the direction they are giving, we are functioning. We are the agents of the board. Right? Then we'll go to who should own the credit policy, business or risk. The business line, the people who are responsible for bringing business to the bank should not own the policy. We should not formulate the policy because our function, our thinking is towards acquisition, granting credit, getting profit, like that. Therefore, the business line should not be the people who are formulating the credit policy, because it is the risk appetite, risk guideline. So it is a control document. Therefore, risk department is the one who should prepare the credit policy. They are the custodian of credit policy. The ownership, the approval has to come from board of directors, but the custodian of credit policy, who creates the credit policy, is the risk department. Saying that risk department should not prepare the credit policy without the consultation of the business line. Otherwise, we will never be able to lend. So it is a joint task of the business line and the risk department. However, business line can give the guidelines, directions, and requirements, but it is the risk department who will formulate the credit policy for the approval of the board of directors. So through the credit policy, board will give us the direction, but to give us direction, risk should be able to give directions to the board. So if based on the board's risk appetite or the board's broader view of the credit culture and credit requirement and all those things, they will get the risk to formulate the policy and they will approve. So ultimate ownership lies with the board of directors. Custodianship or the preparation ownership lies with the risk department, but in consultation with business lines. Otherwise, we will never be able to give funding for a customer. Then what should be the underlying basis for creation, revision of credit policy? Factors that influence credit policies. When we are preparing the credit policy, what are the factors which influence the preparation? First and foremost, capital position of the bank. Hope you can remember the graph which I drew. You can see the board. This one. CASA, D, term loans, money market, and capital. This is the owner's funds, our shareholders' funds. Because in order to grant credit, we need to have our own funds, right? So if you want to give 100 rupees, we need 12 rupees of our own funds. The balance can be financed through this. 88 rupees can be borrowed. These are borrowings. Borrowed. This is own funds. This is borrowings. And 100 left. Right? So credit policy depends on the capital availability. Right? Credit policy depends on the capital availability. Why? If you don't have capital, you run out of capital, then policy will be very strict. So whatever the capital we have to lend to the very safe. Can you remember the principles of credit? First one is safety. Second one is liquidity. So if you take high risk credit, your liquidity may come down, safety may come down. Then you will lose your money. Therefore, whatever the capital we have to give it to the best people. We may forego profits. We run on to a principle called risk-return trade-off. Higher the risk, higher the return, lower the risk, lower the return. We call it risk-return trade-off, right? See, if you take a credit card, it is a high risk. You just give a card, plastic piece. So you are charging high rate, 24%. You give a temporary overdraft, it is high risk. So you charge higher rate. But you give a housing loan, it is low risk. You charge 10%. Higher the risk, higher the return. Lower the risk, lower the return. Right? So when you have the capital position very weak, you have to think on quality credit only. So the credit policy will be tightened to match that capital position. Right? Then position of the local and national economy. See, economy like this today, where we need to give money and we need to accommodate the businesses, otherwise economy may collapse. 52% of our GDP is brought in by SMEs. So if at this moment of time, if the credit policy starts saying, no, we are not taking any risk, we are lending only to the very good people at the top of the pyramid of businesses, we can't run. So we will have to come down slightly and accommodate moderate risk. So based on the national economy, we will need to look at. If everything goes bad, again we will have to run back and say, no, sorry, we are not putting our money in bad economy. So it is a give and take. Then the competitive position. When all banks are lending, I can't say, no, I'm not going to lend. I will be lending only to the super good people. That can't happen, then we will run out of business. So you have to match that, the competitive position. Then the credit culture, that is how the management look at and evaluate credit. I spoke to you about the three cultures which I just told you. So based on the credit culture also, credit policy changes. Earning requirement and expectation. If my shareholders want a good ROE, we will have to take a little bit risk. If my shareholders are not worried about ROE, about profit, but quality and those all stuff, then we can go with tighter credit policy. Deposit variability. See this. You can, though I'm presenting, you can see the board as well. Here, major part is TMD. Like in our Sri Lankan banks, major part is in TMD, right? Term deposits. Your CASA is slightly lower than compared to some Asian countries. Okay. So you may have 3 months deposit, 6 months deposit, 1 year deposit. Rarely we will have 3, 4, 5 year deposits. Based on that, our deposit portfolios, liability portfolios, we will have to adjust our credit policy to say, okay, now you give long-term funds, now you give short-term funds, based on the availability of our deposits, variability of deposits. Credit needs of the operational area. You operate in Anuradhapur and Polonnaru and you say, we are not giving funding for agriculture and paddy. Can you operate? It is very difficult. Therefore, credit policy should look at that. Legal and regulatory requirements and monetary policy of the country. Based on the legal requirements, regulatory requirements, and monetary policy of the country, we need to balance our credit policy. So it starts with capital availability, economy, competitive position, credit culture, earning requirements of the shareholders, availability and the mix of deposits we have, pre-lending, credit needs of the operational area, legal and monetary policies. That is the factor, those are the factors which influence the credit policy decision. Then the minimum elements in the credit policy as per CBS said, Central Bank. What are the minimum items we should cover under credit policy? Written policies that define target market, risk acceptance, and approving authorities. So credit policy should say what is our target market, what is our risk acceptance criteria, who has the delegations. Then it should cover credit management practices like biannual or annual industrial studies, single borrow limits, how we should visit the customers, when we should visit the customers, what should we do on a visit or a call, like that, credit management practices. And then establish and maintain appropriate risk limits and risk management procedures. Like, then there was another thing, requirement for every obligo and the facility to be assigned a risk rate. All our customers should be risk rated. We will discuss these things later, but everyone should be rated. Based on that, okay, AAA rated customer, this is the amount we are taking. AA customer, this is the maximum amount we are taking. For a group, this is the, we have guidelines. Based on that, conservatively, we can have our own guidelines. That's the second one, appropriate risk limits. Then delegation of authority. It is an individual thing. The approving power. It depends on the experience, ability, exposures, knowledge, all those things. So in one grade, everyone won't have the same delegations. But if in the same grade, but you have a higher exposure, higher knowledge on credit, you will have a higher delegation. Then consistent standard for the origination, documentation, maintenance of documents for extension of credit. We will be told, okay, if you are originating a customer, these are the procedures to follow. These are the points to be looked at. These are the documents you need to collect. All those things are covered in origination and documentation. Then when you are doing the evaluation, these are the things. When you are doing the loan documentation, that is the offer letters and legal, these are the documents. So these all things given in the credit policy. And it should not be for one you need this document and for the other you need this. No. If you are originating customer, this is the minimum documents we need. Credit risk limit, obligo, concentration, industry, geography. That means concentration risk. Like I think I spoke to you, if in one area you have given everything for tourism industry, we will have an issue at the moment of time. In another area, you have given only housing loans, you will have an issue. So like that, we have to balance everything. Responsibility of credit function to report comprehensive data for risk MIS. See, MIS data is the key most important thing at this moment of time. Previously, it was knowledge. Firstly, it was experience, then knowledge. Now it is data. Based on data, we do everything. So, if we don't have proper MIS system, we will not be able to run. If I want to know what is our exposure to Russia, I should be able to take it within an hour to within a day or less than that. If I take 3 months to find out what is the bank's exposure to Russia, by that time Russia-US fight has been over. Right? We predict some climatic problems in one area. We should be able to take, okay, what is the exposure we have to these areas and what is the exposure to agriculture, what is the exposure to trading, like that we should be able to gather. So those information we need to feed into the risk MIS system. So portfolios can be categorized and identified based on risk and based on segments, based on products, like that. So minimum things should be target market, risk acceptance, delegation of authority, then risk management practices, risk limits, risk rating requirements, MIS requirement, documentation requirement, early problem recognition. That means once after you grant, also this part covers. That umbrella which I drew covered from the origination to the end. So after granting, how to monitor, how to identify problems, early warning signals I wrote, how to identify problems, what are the procedures we should take for restructuring and reschedulement, when to offer restructuring, when to offer reschedulement. If NPL, what should be the procedures, how you should manage your provisioning, all those things covered under this. All these things should be in the credit policy. Will there be exceptions allowed? Yes, rarely, though, exceptions are allowed. Right? We allow exceptions but very rarely. Whenever we allow an exception, it should be approved by the original approving authority of the credit policy, right? That is board of directors. They should approve or ratify the exceptions. But there are no exceptions, strictly no exceptions to a credit policy. Funding for pornography is strictly no exception. Then funding for any action which detrimental to the well-being of the society and the state, that is terrorism funding, arm funding, drug trafficking, all those things are no exceptions. At any cost or any circumstances, the bank should not fund this. That is the Sri Lankan credit policy. How the policies can be structured? If you remember, you had a bigger umbrella. Within that, you had segments like SME segment, retail segment, corporate segment. Within that, you will have products, that is term loans, leasing, pawning, like that. So you have the overreaching umbrella, then you have segment umbrellas, then within that, you will have product umbrellas. Depend on each bank's approach towards credit. So if you don't have a segmentation, you will not have segmentation, only products. Nevertheless, there should be overriding policy document as overreaching umbrella policy, which govern all. That is the large umbrella. For example, SME business, customer segment, credit card business, product, leasing, it is product. So overreaching umbrella, segment umbrella, within the segment umbrella, you will have a product umbrella. Why credit policy is such a important, right? It is very important. You can see the importance based on the efficiency you receive in the credit department due to credit policy. You can see the importance mainly through the efficiency, operational efficiencies we gain in the credit department. Firstly, it is set out clearly loan origination and granting process. How to get customers, what information, how much credit, how long, all those things are given in the credit. Then improves internal communication. That means everyone in the credit department, they will know what is my function. Whoever inputters, whoever initiators will know, okay, I need to do this. Checkers will know what is my job. Approvers will know what is my job. Documentation part people will know what is my job. So it is very easy for internal communication. Then again, it will clarify the work of the credit and sales. Otherwise, sales will try to do credit function and credit will try to do the sales function. So they will know their own functions properly. Therefore, it is easy for us to run the business. Set out the steps that need to be taken to mitigate risk and minimize losses to maximize the profit. It will say what kind of securities we need, what kind of payouts we need, what kind of products you should give, what kind of covenants you should put. All those things they will. I will be covering these subtopics subsequently. I'm just giving a broader picture, right? Risk mitigation. Then it will give the delegation. So the people who recommend credit knows where to go. What is the delegation? From whom should I get the approval? All those delegations will be there. Commercial cycle is origination to end. what is the process and the timing. Then in my previous diagram, I drew CRD and LRM, that is loan review and monitoring, portfolio management. So once you approve, you have to review that. That is a requirement. So we have controls, rules and regulations. And there is a law in an order. So loan review creates a impact on the approving authorities. If you have done something wrong, they will straight away point it out. So it is almost personal. So that is the criteria given by the regulator to streamline all operations. It sets out provisioning policy, impairment policy, which we will discuss later, right? For bad credit, you need to allocate part of your profit, right? That is called provisioning. So it's a very important document. Why it is important? It will improve the efficiency and effectiveness of credit department, right? Because it will give you out loan origination, granting processes, internal communication will improve because everyone will know what is their roles are. Sales and credit functions separated out. Risk mitigation techniques are given. Approving authority levels are given, right? Commercial cycle, loan review, monitoring, portfolio management, and all those things are given there. Provision and policy also given. It is like this. It is like a family. You have the overreaching umbrella, then you have the segment umbrella, then you have product. So it is to protect the money of the bank. It is to protect the money of the bank because safety is the key most important factor. You can see out of our funding, 90% is borrowed money. It is not my own money, bank's own money. It is borrowed money. So we need to give out the deposits. We have to pay our loans. Therefore, we get money in the form of deposits, we lend and collect and repay. So safety is the key important point. In order to give this safety, this credit policy comes in. That is the first part of the lecture. Do you have any questions from credit policy which I can answer you?
So with regard to load review mechanism.
Yeah.
Now the loan review mechanism is done after a facility has been disbursed.
Yes.
I mean, if there is an issue in the facility disbursed, what's the role played by a loan review mechanism? In the sense, if there's an error, how will that be corrected? Should it be corrected, and how does it happen?
Yeah, loan review, like we had two things, CRD and LRM, right? CRD is prior to the approval. It is a like independent people under risk with the approving authority. They will review the papers, and I'm talking about the higher value loans, right? Not the smaller value loans. So independently, they will say these are the shortcomings you have on this paper, right?
Okay.
That is to put the credit onto perspective and create a safer environment on credit. Okay, that is CRD. But after the approval, LRM comes in. LRM function is to find out any regular mistakes or regular errors and omissions done by the approving authorities. Is there any trend? Like if when you are evaluating some papers, you see one approver don't care about the CRIP. Then LRM will report to the risk board risk committee saying that the CRIP is not given proper weight. So the board risk committee can take a decision on the approval. And
right.
it is a police mechanism. Okay.
All right, sir. All right.
That is to find out any trends and take actions to avoid future doing of the same things.
So, and this LRM function happens based on the quantum of the loan, isn't it? Is it? It doesn't happen to all the loans, no? Is there
It is
a upper limit?
it is like this. Guideline is you need to evaluate 40% of your approvals within 3 months from disbursement. Okay.
All right.
But a bank can decide what is our significant level, and above the significant level, 100% of the approval. We say
Right.
we have decided 50 million is our significant level. All the approvals above the 50 million you need to review. Right?
All right. All right.
However, overall approval 40%.
So, one more question with regard to this credit policy. Now, it was stated that the risk department gets involved in the credit policy in consultation with the business units.
Yes.
But doesn't the credit department itself also get involved? Do they get involved?
So, when I say business unit, it is the credit and the business lines.
Both together. Okay. Okay.
Both, everyone together. That is not, what I meant was risk alone should not prepare the credit policy. So it should, operation department should get involved, the sales department or the sales force should be involved, then credit operation should involve, everyone should involve, like the
Right,
SME segment, corporate segment. If you have a centralized credit, those people, everyone should get involved.
Okay, so understood. Thank you.
Right. Then I have another question. Does the single borrower limit differ from bank to bank? Isn't it regulated by CBSL? Yes, it is regulated by CBSL. Single borrower limit depends on our capital, right? 25% of capital, 33% of capital. So if a bank has a higher capital, they can have a higher limit. If you have a lower capital, you can have a lower limit. Did I answer Akitma? Did I answer your question?
Yes, sir, I got it. Thank you.
Okay. Anyone else? I prefer you asking questions so you get your issues sorted. If you don't want to on your mic, you can write, I can answer. Any other questions? If no questions, I'll go to the other part. Right? Now we will see what kind of borrowers we will have, right? So we discussed the credit policy. Now we are going for the origination. In that process, we should know what kind of people we will meet in the market. Firstly, we will meet individuals, right, who are earning a salary and who need money. We spoke about consumption lending and commercial lending, two things. Consumption lending is we give out money. Once the purchase or the end use happens, end use will not generate any income to service the loan, like buying a vehicle for personal use, buying a TV, buying a house, all study purposes. All those things are consumption. Once you give money, it will not regenerate money to service the loan. So in that process, you have to identify the income source of the customer. So personal customers are customers who are salaried and they want to borrow. Based on the salary only, they will pay. So mainly individual borrowings are for consumption purpose, not for business. It is consumption. So we give personal loans, we give credit cards. Personal loan can be, the money can be used for any ultimate legal purpose. Credit card also the same, you can use as required. So you are responsible, the person with the NIC is responsible for the borrowing, and the repayment happens from his or her salary or income, right? So they are called individual borrowers, right? These are the things you can do with them, and this is the funding. In Sri Lanka, personal income is taxable. So when you are talking about repayment, taxable income will be there because you need to pay tax. So repayment capacity will be considered after tax payments. Then comes the same individual if doing a business, right? You can be categorized as a sole proprietorship. I have a business, I'm doing it to earn money. Now it is a business customer. So it can be a registered business, or I just have a name but I have not registered. Still, the person is liable for his borrowing. Personally liable for, we say, Indica grocery, right? It is a sole proprietorship. I'm the owner. So you have registered as Indica grocery. If you go and borrow under Indica grocery, still I am responsible. You are the owner of this business. So you are responsible for the repayment of facilities taken under the business name as well. Sole proprietorship can be registered or unregistered. You are personally responsible for this. Then comes partnerships. 2 or more people, maximum of 20 people, can come together to run a business, right? Here, you need to register a partnership. There can be a partnership agreement between them or without a partnership agreement. but you have a registered business. It is governed by Partnership Act of 1890 or Partnership Ordinance 179 1981. Right? You can have maximum of 20 people together. Partnership agreement is not necessary. You are allowed to operate the business. Each partner is responsible for the dealing of the business. Right? If I am in a partnership, I can't say, no, I didn't get the money, it was given to someone else. No, everyone is equally liable. Unless otherwise, partnership agreement says. Right? Equally liable. So even if one partner goes and borrows something for the business, everyone will be liable. However, banks don't take any chance. For all documents, we take the signature of all the partners. Right? Law says even one partner goes and borrow on behalf of the business, then others also liable. But we don't take a chance. We take the signature of everyone. Right? Everyone in the business is liable personally. Remember, personally liable for the borrowings of the partnership. Then, if one partner dies or resigns from the business, his or her liability will end at that point. Right? So normally partnership should be dissolved, or other partners should be agreeable to take over the liabilities of the demised partner or resigned partner and run the business as it is. Else, we need to dissolve the partnership and settle the liabilities. You are not allowed to just do the business. Right? Partners are personally liable. You can have 20 partners maximum. You can have a partnership agreement, or you do. It is not necessary. Partnerships are governed by Partnership Ordinance 179 1981, amended Partnership Act. Right? Then, if a partner dies or resigns, their responsibility stops at that point. If other partners are okay to take over the liabilities and run, we will allow the business to run. Otherwise, liquidate the business and pay all the dues. Even one partner borrows, it is the responsibility of everyone to honor that borrowing. But we don't take any risk. We take everyone's signature for all the documents. So this is the way how we write. Messrs. Albert, Wilbert, Norbert, we put everyone's name, carrying the business under the name of registered business name. Right? So there is a registered business, similar to sole proprietorship. Everyone is personally liable. Right? Then comes the limited liability company. This is the first time a separate legal entity creates. Shareholders, the owners of this business. So now we had Indica Grocery, which is a sole proprietorship. Then partnership, myself and my brother, Indica I&M Grocery partnership. So it is a partnership. Then comes I&M Private Limited. Now it is a legal entity. The owners or the directors of the business are not liable. The company itself is a legal person. I have a legal personality as Indika Kudagamagi. Similarly, my business Indika and M Private Limited will have a legal personality. So if you lend to the company, not to me. I'm a director, but you lend to the company. If you write to the company, not to me. Company is responsible for all dealings with the banks, all borrowings, all operations. So companies are governed by Act number 7 of 2007. That is the latest Companies Act, right? So all communication between the financial institution and the company happens through board resolutions, right? Board of directors should pass any item, resolve it, and the board resolution should say, okay, allowed to borrow this for this purpose. Signing can happen with 2 directors or director and the company secretary. Under new act, there can be 1 director companies. So theoretically speaking, director alone can sign a board resolution, but for the safety of the bank, we always get the director and the company secretary to witness the director's signature, right? When the board resolution comes in, embossed seal, which is the representation of the company, should be there. And the 2 directors will witness the embossed seal. But as per the new Companies Act, you don't need embossed seal, but if you have the company registration number in the director's company seal, just the director's seal, it is good enough. It is as good as embossed seal, right? So limited liability company is a legal entity created by the shareholders. So it is a separate legal entity. Directors who run the business does not personally liable for any borrowings of the company. Bank need to sue the company, not the directors, right? So all communication approvals from the company goes on a board resolution. If you have 5-6 directors, 2 can be authorized to communicate to the bank. All documents should carry the embossed seal or director seal with company registration number. Directors are signing on the board resolution to witness only, right? All the facilities given to a company should be registered with company of registrar. Still, the banks has not tested if what will happen. We grant a facility, but we have not registered with company of registrar. What will happen is not tested in courts. So we don't take any risk. We register everything within 21 days of granting the company registrar. In a dissolved position, if a director dies or resigns, there is no impact to the borrowings or the liability of the company. Companies are allowed to operate, not like in a partnership, right? Because borrowing happens at the company level, not the director level, right? If a company declares bankruptcy, then company needs to be liquidated, then sell the assets and pay the liabilities. Unless until a company declares a bankruptcy, it is a perpetual entity. Companies are allowed to operate whether directors comes in or goes out. Liability remain with the company, not the directors. Directors or shareholders are not personally liable for the doing of the company. If the bank wants to get the directors personally liable, you need to make them joint borrowers or at least take a personal guarantee from the directors. Otherwise, you can't do anything. That is a limited liability company, PV Ltd, right? That is the end of the company. IK within bracket PV and PV number, just the PV and the Ltd. Then you have, I covered this, liable companies are not authorized. All right, I didn't say this one. Previous Companies Act, there was a clause saying these are the functions this company can do, objectives, right? That is called ultra-virus clause. However, this new Companies Act is silent about that, right? New Companies Act is silent about the objectives of the company. Therefore, without checking the objectives, you can grant loans. Previously, a company incorporated for land development. If you give money for trading business, you can't sue. Your objectives are different from borrowings. But now, objectives are silent. Ultra-virus clause, it is silent. Therefore, land company also can borrow for trading. Then public companies. It is also a limited liability company. It is also a company where directors run the business, but the company has the ownership. Right? Here, shareholders are broad-based, large number of shareholders. That is called a public company. When you have a large number of shareholders, then it is a public company. You can have quoted public companies and unquoted public companies. If you are listed in the Colombo Stock Exchange, you are a quoted company. If you are not listed, then unquoted. Here, instead of Ltd, we place PLC. After the name, it denotes PLC. Okay. So public companies are companies where you have a broad-based shareholding structure. Major shareholders become directors of the company, right? Though shareholders become directors or independent directors, they are not responsible for any doing of the company, borrowings of the company, right? If you lend to the company. If you sue the company. Again, if you want to make the directors personally responsible, you have to make them joint borrower, or you have to take at least a personal guarantee, right? Joint and several personal guarantee. Otherwise, you will not be able to make the directors liable, because sole proprietor owner is responsible. Partners are personally responsible. Limited liability company, now new legal entity creates. Directors and company are two different entities. Public companies, also directors and companies are different. It is also legal entity. Therefore, this is different. Then we come to the lending on agriculture. Lending to agriculture is very critical because whatever said and done, major part of our economy, major part of job creation, major part of our population is engaged in agriculture one way or the other. But it is very risky and banks are very reluctant to put money into agriculture. It's due to several reasons. Lack of banking knowledge, lack of accessibility to banks, unable to provide collateral, natural disasters. It rains, harvest gets affected, drought, harvest gets affected. All kind of natural climatic changes will affect this segment. Currently, we have a higher default rate, poor financial controls. Therefore, banks are reluctant because of the nature of the business, climatic issues, and the person behind. All those things together, banks are very reluctant. But we need to lend to this sector. Otherwise, without this sector, we can't survive. Therefore, central bank has given a guideline to say 10% of our loan book should be into agriculture. But there are loopholes in that. Tea plantation also considered as agriculture. So what the banks do, they show their tea plantation book for this agriculture. Agriculture is not just farming. It's not just growing vegetables. It is paddy, animal husbandry, poultry farming, fisheries, tea, coconut, non-traditional or export agriculture, vegetable, horticulture, everything. Anything to do with this natural plants and animals. Right? So it is very risky, but we need to lend because we have a guideline of 10% of the book should be into agriculture. So when you are lending to agriculture, always you need to have a second way out or cash flow capturing, and you need to get agri insurance as much as possible. Insurance companies also very reluctant to give agri insurance, but we need to look at. So best way to finance agri is for supply chain financing. That means you have a market participant who buy the products, and based on their products, you can give money to the farmers. Otherwise, money may be used for different purposes. The money diversion can happen because of the lower literacy level on financials, right? Then other thing on agriculture is you can't have standard monthly basis repayment schedules when it is agriculture. See, broiler farms, every 45 days, you will have the harvest coming in. Paddy, you have a Yala and Maha seasons. Based on that only you will get money. Carrot farmer will have 3 months time duration. So if you give monthly basis repayment, you will have issues because you expect the farmer to pay monthly, but whereas their money comes in every 3 months or 6 months. So you have to match your repayment to the cash flows of the farmer. Always you should have a second way out, that is security or something, or you should have a third way out, which is insurance. Insurance is very critical when it comes to agriculture. You give money for a multi-day boat. Multi-day boats normally comes on shore every 45 days or 2 months. So if you expect the owner to pay monthly, we will have issues. So cash flow should be matched. Then we'll come to the others risky segment. It is the small and medium segment, SME. Again, similar to agriculture, SME is very critical. Why? 52% of our GDP comes from SME segment. So if the banks are not financing SME segment, we have issues. We will have issues, right? But SME lending is a very specialized area. You don't have audited P&Ls and balance sheets just to look at and give money. We are dealing with pure people under SME, right? So your experience, exposure, then your education, everything matters when you decide SME lending. Your logical thinking is the key most important thing in lending to SMEs. You just can't look at the P&L and balance sheet and lend. Project visit is a very, very critical function in SME lending. For personal lending, you can take the salary slips and lend. For corporate lending, you can take the P&L and balance sheet and lend. But SMEs, you can't. SME is like a hybrid vehicle. You have the corporate items as well as personal items. So you need to evaluate this segment very carefully, because repayment defaults are very high, similar to agriculture, because of money diversion to other things. They mix their own life and the business. In a shop, day sales is considered as my income, whereas only the profit is the income. All household items are funded by the business cash flows. So this mixing is the more dangerous thing. So we discuss about 5 C's of credit. First one is the character, right? Willingness to pay. That you have to establish when it is SME segment. You can't bypass the importance of credit when you are lending to SME segment. Customers' exposure, customers' willingness, customer stability, business, what they are in, everything matters. So business visit is a key important point in lending to SMEs. We need to lend. Again, we were talking about having a limit, 10% of your loan book to SMEs. Still it is not given, but this year they gave us a direction, 20% of your lending to this segment, 20% of your lending for this year should be directed to SME. If you are lending 1 billion this year, you need to lend 200 million for SMEs, 20% of our lending for 2021. Right? So here you can't look at the P&L and balance sheet. It is only a part of your decision. Whereas corporate lending, P&L and balance sheet, you can lend. Then refinance and credit guarantee schemes. Today also going to be a shorter lecture, right? Refinance and credit guarantee schemes It is again called credit lines. We have two funding mechanisms. We have development agencies like JICA, IFC, ADB, German Development Bank. Those banks are giving us low-cost funds, right? It is like JICA, Japanese Bank for International Cooperation, will give loans to Sri Lankan government to fund the SME segment. That loan will come to Sri Lankan government for 3% for 40 years. Whereas Sri Lankan government will, through the central bank, because central bank is the banker for the government, will give that money to the other banks, right? For maybe 5 years, maybe 10 years, at a cost of maybe 5-6% or 4%. So the banks can keep a margin and relay, but it is concessionary. It is not the market rate, it is lower than the market rate. Forex risk, that is exchange rate fluctuation, is borne by the government, and the credit risk has to be borne by the lending institution or the bank, right? Whether you recover or not, you need to pay it back to the government, right? So in order to take the forex risk, government is giving us money only for 10 years, whereas they can roll over that money for another 30 years. Then only they will have to pay. Okay. So in order to do that, they keep a smaller margin from the money they get. Bank will need to bear the credit risk, where repayment has to be happen to the central. But whether you collect money from the ultimate borrower or not is not the issue of the government. It is the issue of the central bank, issue of the participating credit institution, the bank, right? Therefore, we keep a margin, maybe 3%, maybe 4%, but there will be a cap to the amount we can keep. So it is always below the market rates. So this kind of a concessionary funding is called credit lines. It can be directed towards different industries. Normally, trading business is not allowed under credit lines. Again, land purchases are not allowed under credit lines. Loan takeovers are not allowed under credit lines. Right? Trading, loan purchase, loan takeovers from other institutions, and property purchases are not allowed under credit line. Mainly, credit lines are directed towards machinery acquisition or sometimes factory expansions, mainly to create jobs. Right? There were very small credit line under KfW, German Development Bank, for trading business. That is for my 23 years of credit exposure, that is the only credit line which came for trading business. All others are not for trading. Then we talk about credit guarantee schemes. I told you money, before that. So what I explained to you was the money comes from other donor agencies or other multilateral agencies towards the country, and we are participating organization who relate to the normal borrowers. Similarly, government can decide, okay, for SME segment, we are giving low-cost funds. In order to do that, central bank itself give us low cost funds like Saubhagya Renaissance Scheme, which came at 4% lending. We got it at 1, we kept 3, and we lend at 4. Right? So it can be central bank directed concessionary scheme credit line, or it can be donor funded money. However, whatever the scheme, first we have to lend to the customer and we have to claim from the central bank. It is not central bank has given us money and we are lending. No. We have to lend and we have to claim. That's called refinancing. Our money use has been financed by the concessionary credit line. Credit lines, refinancing is that. Then we'll come to the point, credit guarantee schemes. Earlier I told bank has to bear the credit risk. What is credit risk? I will discuss detail. Credit risk is once I give out money, will I be able to get that money back? Right? So when a bank lends to a borrower, it is the bank's problem to collect from the customer. The bank can't say to the central bank, I gave out money, they are not paying, therefore I can't pay. You can't say that. You have to bear that risk. That's why the banks are allowed to keep 3% or 4%. Central bank needs their money back without any question. Right? Banks can't default. So the central bank or the government is not taking the borrower's risk. That is credit risk. So under credit guarantee schemes, what happens is it is like an insurance. Bank can pay a smaller commission to the credit guarantee scheme and say, if my customer does not pay, I will call upon that protection. Right? Latest credit guarantee scheme came through Saubhagya Renaissance phase 3. There was a credit guarantee scheme which covered 50% of the loan. If the customer does not pay, we can take that money from the central bank. Right? In order to do that, we had to pay 0.5% or something smaller commission to central bank. Right? That is a credit guarantee. It is like an insurance. If my customer does not pay, I can call upon that. So the credit risk passed to the credit guarantee scheme, not to the central bank again, or the bank is not bearing. So in order to get that credit guarantee, we have to pay a monthly or quarterly premium. So currently, the country is under discussion to have a credit guarantee organization. Right? So all banks will be there. There will be a fund. So we can get an insurance, credit insurance from that organization. In India, Malaysia, Singapore, Thailand, all these countries, they have credit guarantee schemes. So banks are free because banks, end of the day, lend depositors money. Right? When I have the credit risk, I'm very careful. Otherwise, I will lose money which I need to return to the depositors. When I have an insurance premium, where if in a bad day where I can go back and claim my money, at least part of money, banks are free. So banks can freely lend to the micro and the SME segment, which is the growth engine of the economy. Right? Credit guarantee schemes will have to be introduced to this country. Now this government is looking at it to create a credit guarantee scheme. So banks can take a protection from them and lend to the SME. We will not have 100% guarantee, but at least 50-60% guarantee will be sufficient, right? Because when you are lending to SME segment, collateral is one key issue they have. They have a good business, but they don't have wealth to keep as a collateral to the bank because they are still growing, right? So banks also don't want to lend without a fallback option. If they don't pay, we have to collect money, so we will sell the property. Without that kind of a thing, banks also does not lend freely. If we have a credit guarantee scheme like this, we can pass part of our credit risk to them and freely give money to the SME segment, which is the more critical segment. SME segment is defined differently by different credit organizations or different organizations. Like small industries ministry define SMEs one way, Export Development Board define one way, central bank defines one way, and donor agencies define differently. Central bank gives the Basel guideline, which is the annual turnover not more than 750 million rupees. That is the guideline for SMEs through central bank. In international arena, SMEs are categorized based on turnover, investment in the business, and the number of employees in the business. Small, medium, and large. Small and medium is SME, large is the corporate sector. Right? Why we need classification for SME is to identify proper SMEs and redirect this refinance schemes or give facilities to SME to grow the SME business. That's why we need refinance schemes, right? And SME definition. So this comes to the end of the second part of today's lecture. So we discuss under this type of borrowers. Initially, the personal borrowers, which specifically borrow for consumption purpose, not for productive purpose. Consumption means once the purchase or the once money is used for the end purpose, no money will be generated for the repayment of the loans. That is housing, education, vehicles, that kind. So repayment is always based on the salary income, confirmed income. So the documentation required is very minimal on that. So that is individuals. Then comes the individuals who are doing a business. Their income levels may fluctuate, not like a salary. So you have to be careful there. So it can be a registered business or unregistered business. End use is for always for productive purpose, commercial purpose. That individual is responsible personally for his borrowing for the business. Then it is a sole proprietorship. Then you have the partnership where you have 20 partners maximum. You may or may not have a partnership agreement. Everyone is responsible for the borrowings. So everyone needs to sign on documents as per the bank. But the law says even one person borrow on behalf of the partnership, everyone liable, but we don't take a chance. We sign everyone's this. If a partner dies or resigns, his liability ends at that point. So the partnership needs to be dissolved. If not, other partners need to take over that liability, then only we can allow the partnership to operate. Then comes the limited liability company. That is the first point. We create a separate legal entity. Directors are not responsible for the business borrowings, right? Company, banks needs to deal with the company, right? If you want to capture the directors, you need to take the personal guarantee at least. So all borrowing dealing has to be deal with the company. You sue the company. So all the financial dealings done with the companies need to be filed at company registrar of companies, right? If a director leaves, it is immaterial for the company's borrowings. Companies are perpetual until they declare bankruptcy. Limited liability company. When the shareholding structure is broad-based, it is a public company. Then at the end of the name, you have PLC, public limited company, right? That's also the same. Directors are not personally liable. If you want the directors to be personally liable, you need to have their personal guarantees minimum. Then we came to agriculture segment, which is very critical. Takeaway point is your cash flows should, repayment should match the customer's cash flows. Always you need to take an insurance policy to have a third way out. Then we came to refinance schemes, which is the concessionary funding. However, we have to take the ownership. We have to, they are the credit risk. Then we came to the credit guarantee schemes, which is a insurance for non-payment of loans. We should be able to buy that policy. In case of a default, we should be able to call that policy, right? So that covers my second part of the lecture, and that's it for today. If you have any questions on the second part, I'm happy to answer you.
So what about a borrowing of a company with a single director?
Still, it is the same thing. Company is liable, not the director. Company
That
is
loan
a
has
separate legal entity.
okay. So the company has to repay the loan anyway.
Yes. If you want the director to be responsible, you need to have the director's personal guarantee.
Okay.
Right? Anything else? Anyone else?
So what's the significance of this director seals with the company registration number? What's the significance of that?
Earlier, we have to have an embossed seal, right? Embossed seals give the company registration number there, right? With the new Companies Act, it is not necessary to have an embossed seal, but director seal, you should have the company registration number. That is the difference. Because you have the board resolution. Just hold on. Right? You have the board resolution. In the board resolution, you place the embossed seal, two directors sign from these two, right?
Okay.
Witness in the embossed seal, right? Now, under the new guideline, embossed seal is not necessary because embossed seal says the name and the company registration number. But the new guideline is, even if you have a rubber stamp with the company registration number, that is good enough, right? Directors are only witnessing the board's company's decision. All decisions are governed by the board resolution.
All right. Thank you.
Right? Okay. Anyone else? What do you mean? I'm not familiar with UBO. Sure. Can you? Okay. So for the ultimate ownership, sole proprietor is always the ultimate owner. So they are personally liable. Partnerships also, you are personally liable. Therefore, you don't need any other thing. Only companies, directors are separate from the company. If I can remember correctly, we don't take any separate document. Manisha, did I answer your question? Okay.
So there is one more question with regard to partnerships.
Yeah.
In a partnership, if a partner dies, what is the more prudent way of doing this? Is it as a bank, should we let the loan go as it is, or whether it has to be fully settled and re-grant?
Best way is to re-grant, right?
Right.
Because always there will be a loophole in the loan. But
Okay.
we say, okay, we agree to take. When it comes to a legal battle, they will prove differently. So it is always better to have the new registration without the partner who demise and re-grant. That is the best way. But it requires the partners to declare that we will take everything and go ahead as well. But first one is preferred, re-granting.
All right, sir. Thank you.